Hello everybody, welcome to TraderMerlin. It is your Hump Day Wednesday edition, alone in studio again. I say studio, you know I'm broadcasting from my home, so the fun of doing this from your home. Happy Wednesday everybody, hope you had a great session out there today. Really crazy rally right at the end of that market, which obviously was, I'll say was a nice bump, but I didn't like it because obviously with my position short, a 35-point rally in the S&P in the last 35 minutes, the market was pretty depressing. But all in all, it was good seeing those markets down the way they were for my short positions. Hopefully you guys are short as well. Today's topic is the market mantra, sell in May and go away. I'm going to do my opening markets here and go through some of the earnings calendar as well. And after that, we'll dive into what do these market mantras mean? Should we pay attention to it? Because right now, if you're listening to that mantra, you want to look at the facts and figures that have happened over the past few years and over the course of the history of the market to see, is this mantra even true anymore, or should we just kind of discard it? Because it is mid-May right now, and some of you may be getting ready for that type of trade. Yes, it's May the 13th to be precise. All right, let's get things started with some of the economic announcements and earnings calendar information. Economic-wise, it was really about crude oil inventories. They actually saw a decline of 400,000 barrels, which was kind of a shocker out there. I did not see that one being that exaggerated. We talked about it declining, but that was the major one. Here's what came out with earnings-wise, aftermarket and pre-market. Aftermarket, we have Cisco, which reported 79 cents versus 72, so they beat pretty handily. I was really surprised to see Sony not. I just assumed, and kind of seeing what Nintendo did, that Sony would probably do rather well, given the fact that a lot of people are probably buying PlayStations. I bought probably 3 or 4 different PlayStation 4 games just to occupy my quarantine boredom. Sony missed pretty decent. I mean, they were expected to make 30 cents per share, came out at 9 cents per share, a miss of about 70%. Surprise. That was really it on that front. Now, I'll go over to our markets here, and I was looking at Zoom. This is funny. I really actually thought about potentially shorting Zoom here. It seems to me like as soon as this quarantine thing is done, a lot less people will be using Zoom. And also, Google came out with their competition to it a couple days ago, and I think that Google probably knocked the socks off of Zoom because, well, Google has the infrastructure. Zoom is still building it and using money like this to get it going. So, this isn't about Zoom, though. Let's go and look at our top 7. Russell 2000, again, the ugly dog today. Now, this is noteworthy simply from a technical perspective. Remember, we drew that trend line in loosely yesterday. I know a lot of you who are trend people are going to go, oh, God, why would you draw it there? You know, we could have tortured it and fit it right into here. That looks like it hits a bunch of points of contact. Either way, the price action that happened today broke down below that trend line. That's the first step of the reversal here that may be coming. So I'll remove this trend line now and we go to the second step, which would be it's got to start making new lows. Now, the low that we saw happen on the 4th of May, that was the most recent low, which of course would be the line in the sand for me, which is right around 12.19. Actually, I'll call it 12.20. My snap tool isn't on here. Let me turn the snap tool on just so you guys can see that number a little bit better. So we'll go exact, and there you go. So 12.20 was that low. We did breach it today, but we didn't close below it. A close below it would give me much more confidence that this thing is starting to reverse. We've had 3 down days in a row, certainly coming into an area of demand right around 1200 on that RTY futures contract. All in all, it was your worst performer by a good margin, almost double what the other indexes were today. That was down 2.5%. And I like the closing number, 1, 2, 3, 4. There we go. All right, the one that I'm in short, S&P 500, similar picture. You know, what's noteworthy here with the S&P 500, certainly it was down 1.17%, but it was close to 2% earlier on in the day. What's noteworthy is its inability to make this most recent high just 3 sessions ago. That was really what made me add a bunch to my short position on my options play. As we approach that supply zone, just, you know, I've told you above 2,900, I'm kind of getting a little bit bearish on this one. 3,000, I didn't think we would get there, which we still may get to 3,000, but as the days go on, I think it's getting more and more unlikely. Same thing for the S&P 500. I'm really looking at this low that goes back to May 4th. That's right at 2771. Now, we did not get there today. Certainly a break below 2800 was achieved today, but we didn't close down below that one. I'm hoping we get a little bit further, more move to the south side. All right, S&P, as I mentioned, down 1.17%. NASDAQ faring the best, down 0.92%, but also with a very indecisive candle. This is one of those ones that's got a long topping tail, long bottoming tail. For those who might be listening to the podcast right now, I'll zoom out for you and we can see that one a little bit better. Real big range, but a lot of indecision. That is historically a reversal pattern. Now, I'm not going to, I would prefer if that was much higher up basically yesterday's candle replaced with the one we had today. That would make me feel better about a reversal, but ultimately with these types of formations and candles, you really just have to wait and see what transpires. You have to have a plan in place for either direction. My plan in place is not for the buy side. I'm no longer looking to go long anything right now. I'm basically waiting for something to trigger sell signals for me. For me, that would be the break of today's low on the NASDAQ 100. All right, crude oil down also 1%. So I'm going out of order here a little bit. You see a green candle, but it also gapped down. We are still in that very sideways action. And we have this $25 mark on here. Really, if you get above, we can get a close above 26.40. Then to me, you're off to the races to the next level, which looks to be right around that $35 mark. So this is obviously a lot of room to run here for crude oil. The inventory number today I thought might actually help this move to the upside, but it did not. All right, 10-year, we saw the price of that do nothing, so I'm just going to skip this because who cares? None of you are probably trading the 10-year. We'll go to gold, which did have a nice move today, even though it's in a similar situation of just consolidation. These ranges are getting more and more compressed, which for anybody who's an intraday trader is not good. You want them to be much bigger swings. For the investors, you probably don't really care too much. But anyway, you had a 0.97. We'll call it a 1% gain on gold futures today. 1,723. All right, the big dog, the leader out there today, Bitcoin. Looks like it's going to be racing back to that $10,000 mark if you ask me. 9,400 is where BTC futures are trading right now. That's a gain of almost 6% on the day, making it your best performer by a very, very big margin. All right, let me see. Natalia says the bend at the end. I don't know. It feels that way. Certainly when I looked at the Russell 2000, it does feel like the bend of that intermediate term trend, right? It's not like it's this long-term trend, but it certainly has been a trend since those lows we achieved about a month ago. So yeah, it could be. Obviously the more confirmation we get, the better, but we can't wait for every piece of confirmation because then the train has already left the station. That's one of the reasons I was building up this short position on the ES is I kind of felt it was going to be going higher, just have this gut feeling the way momentum has been moving right now. But if it does what I'm pretty sure it's going to do, which is ultimately sell off, I want to make sure I've got some skin in the game. So I was a little bit disappointed. I know it sounds weird to say. Obviously, I'm very pleased because my position is doing very well. But I kind of wanted it to keep rallying up so I could get to my 400 or 500 mark on that options contract, on the put options there. But just I may not get there. I may be stuck. I know. Heartbreaking to know. I may be stuck with only 320 put options on this short move to the south side. All right. Brendan says, Merlin, I opened some September 185 puts on SPY up 26%. Attaboy, Brendan, that's the same one I'm in. Overall, right now, I think I'm up 50% on the entire position, which is, not too bad. We'll take it. What are the most attractive Bitcoin stocks? Honestly, I wouldn't be able to tell you Bitcoin stocks right now. Let me do a little bit of research on that one because I don't really trade any Bitcoin stocks. All right, let me go to the topic du jour, which is going to be the sell in May and go away phenomenon. It's something that we hear in the market. There's all kinds of market mantras, tons of them, and I'm a big fan of them. I actually believe you need to pay close attention to those market mantras because there is an air of truth to them. However, over the course of time, the validity or the conditions for these specific setups or mantras may change. And don't worry, guys, this isn't vodka. It's water today. I'll save the whiskey for Friday. One of the ones I've loved has been the trend is your friend until the bend at the end. That one I think will be timeless. That will never change. The sell-in, as goes January, so goes the rest of the year. Statistics have shown that actually to be more true than false, right? So it's nice to look at those ones. The Santa Claus rally. There's another one where you look at it and you say, well, that one actually does bode pretty well most of the time. But as Brandon Wendell and many of my other colleagues would say, everything works until it doesn't. So if we go into this mindset that we should sell in May and go away, we certainly need to have a plan in case it doesn't sell off. So why is this in place anyway? Sell in May and go away was really due to the belief that during the summer season, most of the institutional guys are taking vacations, there's less volume, it just slowly drifts down. Well, that was the case up until probably 2008, 9, 10, somewhere in that ballpark. But it wasn't that they were really negative, it was lackluster. So I wanted to bring up some supporting information to drive home how we break this up. So let's say we took two chunks. We took May to October, And that's 6-month period. So May 1st, you sold everything in the market and you went to bonds or something else, and you close that out October 31st. That 6-month window is what we're talking about. That is the sell in May and go away. It's a 6-month period of time. Now, there's two, obviously, if we cut the year into 6 months, there are two pieces. So that piece from November to April, so you go November 1st to April 31st or 30th, those are our two chunks. And you wouldn't think that one of them would be statistically such a huge overperformer and one an underperformer, but that's exactly what they are. So let me show you some charts here. And I found some really cool illustrations that really show you not just the US markets, but this is a global issue. This is something that happens around the world, so why not take a peek? And we'll start with Canada, because I got Brendan in here and I want to show it to our neighbors of the north, give a little bit of a Canadian love out there. What we're looking at here is three things. Number one, you're looking at the S&P TSX, which is the representative of the Toronto Stock Exchange. That's that blue line. And you can see that over the course of time, it's been doing what? It's been going up. And this is from 1970 to 2017. There you go. I don't know what this is. I think this is green. My color blindness tells me this winter one here is green. And then notice it actually outperforms the market. That means that if you were just in the winter session, so we'll call it winter and summer from now on for this discussion. If you were just in those winter months, November to April, you would have beaten the markets. Well, then that tells you that something must be wrong with the other months. Yeah, look at the lower line here. Maybe somebody could tell me what color this is. It looks like a burgundy or dark red. I don't know. The brown? The summer month here looks to be brown, I guess. I'm going to go with brown. So summer down here at the bottom, if you just held that 6-month window, look at how your performance would have been. It's basically sideways for the better part of 46 years. Yeah, I know. Canada. Yep. Don't worry. Yes, the TSX is, yes, the venture. I think the V is the venture one, right? Anyway, the point here is if you split that year into two 6-month chunks, a winter session and a summer session, if you just stepped away the entire summer month, you probably would have done yourself a favor. But we've got Canada on the hook for that one. All right, let's go. Well, sorry. Actually, these are from a website called Seasonality. I didn't make these. A lot of times I do. Okay, so most of you guys could care less about China because you don't believe any of the data that comes from China. Okay, red or brown. I'll call it red. Perfect. Thank you, guys. I'm colorblind, so bear with me. Here's China from 1991 to 2017. You can see the same thing. That summer month down there in red, it is almost sloping down. Winter is still not beating the Shanghai Composite, but it's close. We'll go to another one here, and I'll go to Germany. Yes. The German market, boy, I tell you what, if you just stayed in from November to April, you would have clearly exceeded the returns. You almost double the rates of return of the DAX if you just stayed in the winter months. Yeah, you know what? A lot of times, and I know some of you guys are going, who cares? This is really, what does it mean? Who cares? How many of you knew that the winter months performed so much better than the summer months? If you did, you probably wouldn't be in the markets in the summer, which leads us to the mantra of sell in May and go away. Oh, but wait, there's more. So let's keep going. I've got Germany. Let's go into Japan, right? Japan, same thing. If you stayed in the winter months, especially in the last since 2000, there's been a huge separation in the returns for winter months versus summer months. And all of these, if you notice, the summer months are just down, 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 looking ugly. So what about Taiwan? I know a lot of you trade Taiwan. Clearly the winter months are what it's all about. I tell you what, if I was looking at my portfolio thinking of an Asian market to invest in, it looks like I'm going to buy Taiwan in November and just forget about everything else. Look at those rates of return are pretty phenomenal. So let's go to a more industrialized country. Let's go to the United Kingdom. So for our Brits out there, and again, this goes to 2017. I'll show you more recent data here in just a second, but these charts are the only ones that I had that I could find that really did a good representation of how these months split up. Again, the winter months for the UK, if you just stayed in from November to April, you would have beaten the markets by a good margin. Summer months, you're basically just spinning your wheels doing nothing. I'd rather take my capital and put it to use in other things, maybe even put it in the bond market, which is historically what people have done during this period of time. And that brings us to us, which is kind of interesting because it almost doesn't make sense. Because you can see the winter months here, obviously doing very well. The summer months, barely performing, and the S&P would actually be beating that. But we do have the S&P moving to the upside, like slightly moving up. And Big Eb says May to October will suck this year for sure, in my opinion. Again, that is totally your opinion. I am of the same opinion. Obviously, you know my viewpoint at this point. And that's why I have such a large position short on the S&P. Normally I wouldn't. And that's why I actually went out to September. I was going to October, but the cost differential really wasn't worth it for me to go an extra month. So I figure September is going to be good enough. Again, I think July and August are going to be the really bad months for the U.S. markets. So let me keep going here. And again, I'm not going to spend a ton of time on these. I could go more and more, but if you guys have questions and comments you want me to answer on today's show, let me know. Type them in the chat because I will have plenty of time to answer questions. All right, so we go from here. And now I wanted to show you another piece of information which I think is very important. Well, let's just talk about 6-month slices. All right, what are we looking at with regards to market performance? Here are every month sliced up. Basically going, take your pick of which month that you want to go to. You get January, February, March, April, May, June, July, August, and it ranks them by performance. So which 6-month window of time has the best performance? Now, I'm not sure what the number of percentage higher is, but the average percent change for November to April, going back into 1950 through today, actually through April 28th. So basically, you're looking at 70 years worth of data. November through April is about a 7-month rate of return percent change. Now, the May through October one is about 1.5%. So you're still making money. And that's why I wanted to bring this up. Because there is this belief system that May through October is just nothing but negativity. It's down, down, down. While there may be a negative month or two in there, if you take that 6 months, generally, remember, these markets are built to go up. You have retirement money being poured in. Usually there's a lot of optimism in the market. Average about 1.5% over the last 70 years. Not too bad for a 6-month window. If you do that for a full year, you're looking at about 3% rate of return. Not great, but certainly better than your savings account that you're getting right now, or even a CD. So, that's pretty funny, Tom. Sorry, Brennan. He says Canada does well only in the hockey months. I'm pretty sure the beer consumption spiked significantly during that window of time. Anyway, I wanted to share that with you because I thought it was rather interesting. Now, what I thought would be a little bit different here is to look at the now. This is all historical. These facts I've been showing you go to 1970s, 1950s, and on and on and on and on. But what about today? So here is the last, since 2014. Had you sold in May and bought back on October 31st on Halloween, this is the returns we had since 2014. 2014 was a 7.1% gain. 2015, you had a slight decline of 0.3%. Other than that, everything was positive. 2016 would have been 2.9%. 17 is 8%. 2018, 2.4%. 2019, the last year, 3.1%. Now, I'm going to go out on a limb and say that this year will be negative. I think you'll see a negative one. And it's not because the sell in May and go away thing. I think that that's one factor to it. I think probably the major factor will be what we're all dealing with right now, which is the coronavirus, the economy, financial and economic data, trade policy, presidential issues and tension and drama. Yes, we do have an election year, which normally people will say, well, markets are never down in election year. Well, it's not that they're never down, but there is a probability they're going to be higher. I would say this one is a little bit different. We have a little bit different year going on this year. So some facts and figures that I wanted to show you guys about the sell in May. So what does it mean? Does it mean that you should sell everything or have sold everything and moved into another asset class? Totally up to you as far as what you feel these markets are going to do. Historically, the advice that a financial advisor would give you would just be stay in your position because they want your assets under management. They could also recommend that you move your money into bond markets or bond funds at that time to give yourself a little bit greater rate of return than, let's say, the historical 1.5% going back to the 1950s. Either way, it's up to you. I think all of you are sharp enough to start formulating a plan on what you think is going to happen. Mine is decisively bearish. I think that'll last my bearishness will probably last through the beginning of the year, certainly through September, August, and October of this year. All right, any questions on that one? On sell in May and go away? I wanted to do it because I got about 3 questions asking if now's the time to sell. Now, one of the areas, while I wait for more questions here, one of the resources that I use a lot would be this guy. And I don't have a new one because they're expensive. This is the Stock Traders Almanac. It's the Hirsch Publications do it. I've interviewed Jeffrey Hirsch on Power Trading Radio a few years back. I'll see if I can get him on the program. this book is awesome. I mean, if you are a nerd like me and love statistics, it's really interesting. The one that they do for sell in May and go away, they call it the most profitable 6-month strategy without the best 6 month, still an eye-popping strategy. And what they do, it's rather interesting. I'll read you the numbers here just so you get a sense of how different it can be by having triggers and signals to help you with this. Because if we take it at face value and say, if I just sell everything May 1st, buy back on October 31st, that's my rule. You might be buying and selling at the wrong times. There are still things that are going to be moving. So what they did is they actually incorporated a moving average, a MACD strategy. So if we applied the MACD, we'll go back to 1950, right? 1950 is the starting point, and say you started with 10 grand, and they ran the math for all this, which is pretty awesome. And you basically had those two little windows of time. You had May to October 31st and November 1st to April 30th. Starting with $10,000 for each of those periods of time, if you started in 1950 and sold in May and went away, or kept it during that period of time, your account would have dropped to negative $1,000. You literally would have lost money because it just slowly just churned it and drifted it down and went negative on it. If you put that $10,000 and just invested starting November 1st through April 30th, but also using, actually, no, I'm sorry. This is just buying. Sorry, this is just buying with no MACD. It would have gone up to $765,000. So 10 grand to 765. When you add in MACD, that number jumped to 2.06 million. That's almost triple the rate of return by using an indicator, which I know is historically lagging, so do you. But it also is one of those pieces that will show you maybe a better time to be buying or selling based off what the trend is at that moment in time. Okay, what do I got from anybody? Questions? Getting 6% per year back on Bitcoin as my holdings, free money. Yeah, well, nothing's free. You've got to ride out those fluctuations. So your ulcer medication is going to start to take a little cost there. Who's going to pal should watch my show. Yeah, pretty sure that they have much better things to do. And besides, they really don't care about me at all. All right, any questions on this? Or any questions you want me to go over today, since that was a quick and easy thing on the sell in May and go away? Bottom line, I think it actually numerically it works. If you're going to deploy more capital, when's the time to do it? Probably November 1st. Now, if the market is selling off aggressively in November, that doesn't mean you should be buying. I would use an indicator or a trigger for yourself and say, I'm going to wait for it to turn and then start to buy. Or maybe it's coming into an area of demand that's a bit further down. Wait for those numbers as opposed to arbitrarily saying, oh, we'll buy it right now. You know, the past couple of days has been a good example. Let me just show you real quick as I wait for some questions to come in here. And you look at the S&P 500. So let me go back to the ES, bring this up to a daily here. You know, if you shorted or sold everything out on May 1st, you would have sold out of the S&P at 27.87. Well, I didn't feel like that was the best time. I wanted to wait for it to come back up to supply. It came back up to supply, which has given me about, let's say almost 140 points. Yeah, 140 points more. That's 170 points. Excuse me, my math is totally up. 170 points more on the S&P. Obviously, that's going to have a huge impact on the rate of return on this option trade that I'm in, but it was saying I'm not arbitrarily going to just go May 1st. I'm going to wait for it to come into an area where I think is a good time to be buying or selling. Okay, so our strategy is based on this type of stock seasonality. That was from Natalia. Not only are there things based off stock seasonality, but one of the things I love about having Don Dawson in the program, or any real like entrenched commodities trader, and I enjoy commodities, but I've got only enough space in my brain for all the info that I do know. There are those in the commodity space like Don Dawson, who I'm going to do my best to get to come on the show, who know everything about seasonality. I mean, they're watching crop rotation, they're looking at the soil counts, they're looking at weather patterns, and that type of seasonality happens all the time. This impacts, obviously, the stock market. There's stock pattern seasonality because of the people who are buying and selling those securities. But certainly, I think seasonality is a much bigger factor when you look at things like commodities because of the seasonality of the growing seasons, of harvest, of distribution channels, of consumption. I mean, those are factors that are critical to the success of anybody who is looking at getting into the commodity space. Corn, wheat, soybeans, all that type of stuff, hogs, etc. Okay. Suraj says you're waiting for Don Dawson. I am too. A lot of traders, unless they have something to promote, don't really want to come and talk. I am getting a few people on the program who, are just trading, and honestly, to come on this show and talk about markets, for a lot of people, they're like, well, why? What's the point? And it's tough. I've been trying to do more and more guests on the show, but a lot of them are like, I just rather just trade. I don't want to make a spectacle of myself. So I'm trying to get more and more guests on the program, and it's a tough sled, I'll tell you. Okay. Rudy says, can you go over in more detail the MACD and how to use it? Sure, I'll do that. Sorry I missed it. What did they buy? ETF or Dow 30 for the study? That's the S&P 500. So the study that you were looking at there, that was pretty much everybody's using the S&P 500 as their baseline for all the data there. Let's see. Any advice on SPX weekly option plays? No, but I will tell you that the guy who is the creator of the rubber ducky strategy, Tim Blotzer, will be on the program next Tuesday. I believe I'm going to have Tim Blotzer on the program next Tuesday. I'm going to have Bill Addis on tomorrow talking bonds, because there's been some really interesting things happening in the bond space, especially with treasuries and the new 20-year. Also, I'm going to have David Warner on Thursday, so I know we've had a few people asking much more about the currency markets. Now, the question that came through was that one that just came through, and don't worry, Rudy, I'll get to MACD here. J. Rob says, what asset classes do you prefer? I like them all. Not to sound overly vague, I love the power of leverage. So I would say that my core, where I started everything, was with equities. Problem is, stocks cost a lot. And I don't mean by commissions. I don't care about commissions anymore. But they cost a lot. Buying 1,000 shares of Amazon is going to cost you a pretty penny. So I'm trying to find markets, not trying to find markets, but I like markets or prefer a market where I have the power of leverage. So that's going to make me gravitate towards futures. I don't trade single stock futures. I just trade index futures, sometimes currency futures, but also the options market, because options can give you leverage. Now, of course, not all things that are traded in the stock market have options on them, and some options you probably shouldn't be trading. But I would say my favorite really depends on what the market is giving me at that moment in time, right? If I see a setup or something happen on a specific stock, then that's my favorite. I'm going to go out there, I'm going to look for that, I'm going to make the trade off of that setup or pattern, whatever that formation may be. Even if I don't get the leverage, maybe I'll jump over the options market if I can to further get some firepower there. I would say, if you just set it at a high level, which asset class do I prefer? I'm probably going to go with the futures market. I like spot Forex, but the problem there is sometimes the brokers, you get some really weird fills and some strange stuff happens. You do have great leverage, tremendous leverage in the spot Forex markets, but sometimes I'm just not, I question fills. I'm like, what? How the hell did you stop me out? It didn't even print on your chart. I'm like, oh, well, we do a hybrid between the bid and the ask. I'm like, you can kiss my ask. Sorry. So, yeah, I would say number one, is futures. Number two would probably be options. Number three would be Forex. And then lastly would be the equity market, stocks. However, that said, I think it's critical that you understand how the stock market works. I think it's unbelievably important that you learn supply and demand on the equity markets, because if you don't know how to look at supply and demand on a price chart for Apple or Intel or Cisco or Goldman Sachs, then you're not going to be able to find the right options to be trading for any specific trade. You need to know what the underlier is doing. So, it's layers upon information. And I would say that the base foundation there would be the equity markets. And then you work your way up into leverage assets. It's just you got to be careful with leverage, because it's that double-edged sword that if you're on the wrong side of something, it could really, really kill you. Why don't you have us as guests? We can go over mistakes. Yeah, Tim is a pretty damn funny guy. I'll have you guys on the show. Why not? Who wants to come on the show? Merlin, if you had to pick one, dividends or automated algo trading strategies? Ugh. Neither. I don't like automated things. You guys got that yesterday when we were talking about trade ideas. I'm not a big fan of automation. Maybe at some point I'll look to automate the way that I trade, the way that I buy and sell things. But I like getting my hands dirty and doing it. So, and I'm not a dividend fan. I've never been a dividend fan, just because I feel like the underlier is where there's a bigger percentage move. What's nice about dividends, obviously, is if you want to generate an income stream. Now, let's fast forward here 20 years, and let's say I'm deep into retirement, and I've got all this capital, and all I want to do is make sure that I get X amount of dollars per month. then I'm probably going to be way more interested in dividend stocks or dividend paying assets. So I know I have a monthly paycheck coming in based off the capital that I have in. So to me, that would be a different moment in time. So there you go. Yes, Sue O'Grady's awesome as well. It's funny. She is one of the most, I would say, unassuming. When you look at her, you would say, if you have to guess her profession, I would say options trader would be one of the furthest things on my mind. But she knows her stuff inside and out really good. Did you see that Charles Schwab will soon let you buy fractional shares of stock? Yeah, I mean, look, basically they're just saying they got to keep up with somebody like Robinhood, where you can buy, small amounts. Fractional. I have this big distrust for the financial markets. If you want to do a little bit of research, look at the DTCC, the Depository Trust Corporation, which was set up by our government. Basically, if you have a Charles Schwab account and you own 1,000 shares that your grandma, 1,000 shares of Microsoft that your grandma gave you years ago, and you're thinking, oh, okay, well, it's just sitting at Schwab. No, it's not. It's at the DTCC. They have everybody's assets. And there's been reports of how inaccurate their accounting has been. So it makes me so nervous with regards to this institution having all of my shares. Now, why did I bring that up? Because if you're doing fractional shares, now I have even more challenges with accounting, because you might not just have 1,000 shares of Microsoft, you might have 1,000.076 shares of Microsoft. Now things get really screwy. So it's a way to get people into automated systems in contribution type programs where you say, you have $10,000, how many different stocks do you want to buy? All right, we'll buy you even of all of these. And therefore, it keeps things balanced. You won't find me buying fractional shares. Why would I need to buy a fractional share? Buy a full share. Rudy says, what's the best way to trade Bitcoin? I have my 2 cents in this one. Brendan will probably have his as well. I would say for me, I'm a fan of Coinbase Pro simply because it's in the U.S. There's a lot of exchanges. Like I love Binance. Binance is a great exchange, but it's China. Well, now it's Japan, depending where they move to now. I want to keep my stuff in the U.S., therefore I can at least go knock on the building door, get regulators or lawyers to go do something about it. As Brendan puts HODL on there, HODL, which is a hold on for dear life. He's saying buy and hold. But if you want to be more active, look at Coinbase Pro. There's two entities there. You have Coinbase, which is where you like the gateway into the crypto space, but the fees on Coinbase are really high. Like it's almost ridiculously high. But Coinbase Pro is their sister company. Same company, just a better trading platform, and the fees are much, much, much lower. So I would open up an account at both places, but trade and make your executions on Coinbase Pro. You're welcome. When Amazon was over $2,300 a share, one share is a large position for some. True. That's true. What they should do is they should just do a split, but it takes away the fun and the volatility out there. Yes, that's exactly right, Robert. It will allow you to get in higher price stocks. See, here's what normally happens. Normally what happens with high price stocks is they split. They do a reverse split. That's the normal thing to do, but some companies have decided not to do that. Okay, I told the gentleman earlier, I think it was Rudy, that I was going to get into MACD. So what is MACD? MACD is simply an indicator that takes into consideration two different things. It takes in a period, two different moving averages, right? You've got a 12 period and a 26. 12 and 26 period moving averages. So I will put that on the chart here just so we can see what happens. Give me a second to settle this stuff up here. Insert analysis technique. And we can tweak this as well. We'll go, it's called moving average convergence divergence, or MACD. It'd be the name we're looking at here. All right, so there we have a whole bunch of lines. Let me get rid of our ATR here. Yeah, sorry. Okay, so at the bottom of your screen, you guys see these colored lines. Basically, what you have with this, the yellow line, is the difference between the 12 and the 26 period moving average. So all it's really trying to do is give you a little hint as to when the tide is turning. If the 12 period moving average goes above the 26, that means it's a positive thing. If the 12 period moving average goes below the 26, that means obviously it's bearish. And I can show you that by simply adding those onto the chart here. We'll go into moving averages, and I'll put two lines on here, and I'll change those time frames to be 12 and 26. So bear with me as I change these inputs just so you guys can see it. 1, 2, and 26. So these on the price chart now, you see a couple lines. Those are the lines that are making up this yellow or gold, yellow one down at the bottom. And all it is the difference between those two lines. So right here, when the 12-period moving average crosses that 26, that's a bullish sign. But it already gave you a hint to buy much earlier, like back here. It gave you a hint to buy 7 days earlier because the distance between those two was getting smaller, showing you that they were already starting to turn to the upside. Right now, it's not really telling you anything, right? Because it's just going sideways. What's nice about this is when you have big trends and things start to turn, then it can give you clues as to when those trends may change, which is why the study done by Hirsch in Trader's Almanac had much greater results, because they weren't buying here when they crossed. They were actually buying on the MACD cross, which maybe got them in a lot sooner when that market started to turn. What's this little cyan line? It's called a signal line, and all they do is do a 9-period moving average. They slow down this yellow line. So we're taking a combination of historical data, the 12 and the 26 period moving averages, calculating the distance, and that gives us this yellow line. Right? So I've got two pieces of lagging information making up this yellow line. And then to give me a signal, I take this yellow line and I slow it down by a period of 9, and that gives me my signals. So that's your very broken down MACD, very quick. And honestly, I have been thinking, guys, some days we go through very basic topics, and I'm sure some of you, I know some guy was slamming me yesterday saying, this is a stupid waste of time to talk about this stuff. Sorry, I'm going to talk about some basic stuff as well, because this channel is kind of for everybody out there. But what I am thinking of doing, time permitting, because I've been really, really busy lately, especially going back and working with OTA on content, I'm actually thinking of making a whole series just on indicators. So basically I'll do like a 5, 10, 15-minute video just on MACD, on Bollinger Bands, RSI, stochastics, all ADX, all of those. And hopefully I'll have some time to do those rather quickly, but let me know if you guys would like that. Natalia says, does MACD work better on a particular time frames? Remember when we had the time frame discussion yesterday or a couple days ago? I don't even remember what day it is. I think it was Monday when I said, what's the best time frame? The big takeaway from that is generally that they work better on the longer term time frames. So I would say they're going to have more validity on the longer term time frames because you're going to catch the bigger moves. However, could I take this moving average I have right now and throw it on top of a 5-minute chart? Absolutely. It's going to adjust appropriately, right? It certainly has its valid points there. I'd be just real cautious with it, because what I get nervous about is people are glued to the indicator more than they are price, right? They're looking at that indicator saying, hey, the indicator told me to buy, and I think that's a challenge. I'll show you why. So you have this market selling off here. I might get rid of some of these lines for you guys, okay? You have this market selling off aggressively, right? It came down below that 2,800 mark, and then right here, it'd be this candle right here, it told you to buy. It told you to go long on the S&P 500 futures contract. But it really just traversed sideways. I would rather you make the decision on going long. Did this hit something, right? Did it come into an area of demand maybe from a couple days ago, a couple weeks ago, whatever the case may be? That's where that decision should be made. And if you look at this line that I just drew, you would have been drawing your demand zone based off of this open down here. There's your demand zone, right? Between 27.71 and 27.94. And lo and behold, we came smack into that one today on a 5-minute time frame. So I would be more inclined for you to be using the demand zones as buy points, and that's, you can see that we ripped out of it today, than using just the indicators. Now, if you bought and all of a sudden you're coming into a demand, you buy because of demand, MACD's crossing the signal line and it's trending up, and now you have one piece of supporting information that might help you to stay in that position a little bit longer and continue to make money to the upside. So that's my quick and dirty on that one. Let's see, what else do I have? It would be interesting to series as a new trader. Yep, cool. Let's see, what else? What other questions I have? So everyone's saying yes, I should make the series. Yeah, I know. It's a lot of work, guys. It's a lot of work when I'm not getting paid. All right. Let me go into what's happening for tomorrow, and then I will bring you guys up to speed. Bring you up to speed on economic calendar, and that way then we can move forward and call it a day. All right, so here's what's happening tomorrow. Nothing really interesting except for one, at least for me, because technology has been such a huge mover and semiconductors have been a catalyst for that. You have Applied Materials reporting earnings tomorrow. They're expecting 91 cents per share. I know we've got a bunch of weed fans in the room today. We also have Aurora Cannabis comes out with earnings tomorrow. Sorry, I couldn't think of the name right there. ACB reports earnings tomorrow as well. And if you've been following the chart on ACB, it has not been a pretty chart, even after their 12-for-1 reverse split. All right, let's go to your economic analysis for tomorrow. Really only one that is concerning to me. Not concerning, but one that I'm really going to be glued to. And that's the unemployment claims. Clearly, we had our spike, a few weeks back at 6.6 million unemployment claims in 1 week. The previous number was 3.1 million. They're expecting 2.5 million, which still means more people are filing for unemployment, but it's certainly a lot less than it was. And 2.5 million doesn't seem unreasonable. Just keep in mind that's a cumulative number here. We're getting to like the 33 million Americans filed for unemployment in under 2 months. That's pretty crazy. So I'm curious to see what that number ends up being. That's an hour before the market opens. You can see Canada coming out with manufacturing sales numbers tomorrow. It's not expected to be pretty, no surprise there. Pretty much everybody is showing really negative revised forecasts. You see Japanese yen with their producer price index showing deflation at 1.4%. The euro looking at having GDP contraction of 2.3%. So it doesn't look good. It's not just the US guys. It's just about everybody out there. Okay, let me see. You got any last minute questions? You could turn those into courses. Yeah, courses mean I'd have to be selling courses, and I don't want to be in the business. So here's the thing. When you start selling things, there's things I can't say. Like, I can't say... this is why the FTC is, in my opinion, just ridiculous. I could not... If I was selling a course to you... I couldn't say, hey guys, right now, I'm up $28,000 on S&P puts, and I'm up $8,000 on S&P futures. I can't say that. I could even show you my screen over here and show you the numbers with a live account and show you this is the trades I'm in right now. There's the 300 put options, $28,000 profit. Here's my S&P, $8,000 profit. They would call that a false claim, because it's not the same for everybody. Of course, I've made that point abundantly clear that everybody's going to be trading different and have different results. So for the FTC would claim that what I'm saying is a fraud, that what I'm saying is not correct. This has been some of the issues that have been going on with Online Trading Academy. And so if I sell something, I can't make those claims. And certain times I do want to say, hey, I'm in this, I'm in that, I'm in this. I wouldn't be allowed to, not that I wouldn't be allowed to, but I'd be on a whole different level of scrutiny if I... would be selling courses. So I don't want to be in the business of selling courses at all. That doesn't interest me. I'll leave that to the people who want to deal with regulators, because regulators, they have a mission, and once they get on a mission, there's almost nothing you can do to stop them. So I'll stay out of that fray. That's not a fight I want to be in. Okay, let's see. Any other last minute questions? I'm almost giving up on Forex. Let's see. I'm using very conservative past year, but options are helping me get back on track. So Jay's been having issues with the Forex side of things, doing a little bit better with options. You've already done the first step right there. You know you're doing better with options than you are with Forex. So if that's the case, what should you do? You should stop trading Forex and just focus on options. If you love Forex and really want to make that work, then I would say scale back what you're doing. Focus on a trade journal, like write down exactly what you're doing, because there's something in there that's just not clicking or not working for you. I would go back into that and revise it and work at it till you finally figure out what that problem is and get better. But I've always been the advocate of, if something isn't working, you have three choices. You can either fix it, you can completely ignore it and it will continue to not work for you, or you can find something else that will be the surrogate replacement for that one. That's what I would be doing. Just make sure it's in hoodies. All right. Cool. Well, that will do it for today, everybody. I wanted to throw together a topic, and I thought the sell and may and go away one would be kind of interesting, especially when you look at all the charts that really do support the mantra of sell and may and go away. But I want to make clear is it doesn't mean that that 6 month window is losing money. It's just not growing at a rate that you would like. It's not a decent rate of return, right? 1.5% going back to the 1950s for that 6 month window of time just doesn't seem like very much. However, that November to April 7+% rate of return, that's pretty decent. Of course, we know the market timing might be able to increase those rates of return. Of course, that's up to you and the strategy that you decide to employ. So that will do it for today, everybody. Thank you guys so much for joining us. If you like the topic today, go ahead and click that like button. Give me a little thumbs up there. If you are new to the program, I know we have a few who are new, click that subscribe button or the little bell that will notify you when I am producing new content. As you guys know, I do this live every day at 2 p.m. Pacific time. I'm also releasing a video every Saturday morning at 10 a.m. Not live, it's just pre-recorded, and then in the near future I'll probably be doing a few more different video types of information once I get a little more comfortable with the graphics. And be a little forgiving, guys. I do all the audio, all the video, all the editing, all the graphics, all that stuff is done by one person because I don't have the studio working behind me anymore. So it may not be the best looking stuff in the world, as you can tell by my studio set here, but hopefully you guys enjoy the content and give me a little bit of slack on that one. All right, guys, thank you so much. I appreciate all your support and conversation today. If you guys want to know more about bonds, tomorrow's going to be very interesting. Bill Addis will be our guest tomorrow. I can't wait because he always has some great information and charts to share with us. We'll be talking about the longer-term perspective of bonds, interest rate products, the Fed, etc. So tune in tomorrow with Bill Addis and myself. Until then, happy trading, everybody. I'll see you tomorrow.